Welcome back to another trading session. So here's what happened. I had already taken my trade position, but unfortunately, due to a technical issue, the video recording failed. By the time I noticed and restarted the recording, the trade was already running in profit, and I was up by $4,700. Now, I know some of you might be wondering, how did you enter this trade? What was your thought process? What strategy did you use? I totally understand, and I don't want you to miss out on any of the details. That's why in this video, I'll be breaking down the entire trade step by step, from the exact entry point to the logic behind it and the key factors that led to this successful trade. I'll walk you through the strategy I used, the indicators I followed, and why I made the decisions I did. So even though the initial recording was lost, you'll still get the full breakdown. Stay tuned because I'm about to explain everything in detail. Let's get started. As you may have noticed, I used the MACD, Moving Average Convergence Divergence indicator in this trade. Now, let's take a closer look at the exact settings I used so you can follow along and understand how I set it up. For the main settings, I kept everything at default because the standard MACD settings work really well for identifying momentum shifts and trade opportunities. Here's what I used. Now, moving on to the style settings, I customized the visuals to make the indicator easier to read. These settings help me easily spot crossovers, trend strength, and momentum shifts at a glance. So now that we've covered the setup, let's dive into how I actually use the MACD indicator to execute this trade. The Moving Average Convergence Divergence indicator becomes even more powerful when combined with an Exponential Moving Average to confirm trends and improve trade accuracy. That's why, in this setup, I added a 20-period EMA with the source set to close, and I've colored it blue for clear visibility on the chart. Now, if you want to refine this strategy even further, you can also try using 20 EMA high and 20 EMA low alongside the MACD. This creates a price channel that helps identify breakouts, trend strength, and potential reversal zones more effectively. If you haven't watched my 20 EMA high-low strategy video, I highly recommend checking it out on my channel. There, I explain how this setup works, when to enter and exit trades, and how to maximize its potential in live trading scenarios. Now, let's go over the strategy step by step in a simple and easy to follow way. The first key signal we are looking for is when the MACD line, blue, crosses above the signal line, orange. This crossover is an early indication that bullish momentum is starting to build up in the market. But we don't stop there. We need additional confirmations to ensure we're making a high probability trade. The next confirmation comes from the MACD histogram. As soon as the histogram turns green and moves above the zero level, it tells us that the bullish pressure is increasing and the trend is shifting upwards. But we also need price action confirmation. This is where the 20 EMA, Exponential Moving Average, comes into play. The price moves above the 20 EMA line, showing that the overall trend is gaining strength. A green candlestick crosses and closes above the 20 EMA, blue line, confirming that buyers are stepping in and taking control of the market. When all these conditions align, the MACD crossover, histogram confirmation, and price breaking above the 20 EMA, this is our signal to enter a buy trade. By using this combination of indicators, we increase our chances of catching strong bullish moves while avoiding false breakouts. Now let's go through an example of a sell trade step by step to make it easy to understand. The first thing we look for is a signal from the MACD indicator. In this case, the MACD line, blue, crosses below the signal line, orange. This crossover is an early sign that bearish momentum is starting to build, indicating a potential downtrend. Next, we check the MACD histogram for further confirmation. As soon as the histogram turns red and moves below the zero level, it tells us that selling pressure is increasing and the market sentiment is shifting bearish. Now, we need to confirm this signal with price action and the 20 EMA, Exponential Moving Average. The price moves below the 20 EMA blue line, showing that the trend is weakening and sellers are taking control. A red candlestick crosses and closes below the 20 EMA, which further confirms that the downtrend is strong. When all these conditions align, the MACD crossover, red histogram, and price breaking below the 20 EMA, this is a strong indication that it's time to enter a sell trade. By waiting for these confirmations, we filter out false signals and increase our chances of catching a strong downward move. Now, let's take a moment to analyze false signals in this strategy so that we can avoid entering weak trades and improve our accuracy. Look at this example. At first glance, it might seem like a buy signal because the MACD line, blue, crosses above the signal line, orange. This crossover usually indicates a potential bullish move, but we need to double check with price action before making any trade decisions. Now, when we look at the price action closely, we notice something important. The green candlestick fails to cross above the 20 EMA, blue line. This is a big red flag. If the price doesn't break and close above the 20 EMA, it means there isn't enough bullish momentum to support the trade. This is what we call a false signal, and taking trades based on this alone could lead to losses. That's why it's crucial to wait for all confirmations: MACD crossover, histogram confirmation, and a clean break above the 20 EMA. If any one of these is missing, it's best to stay out of the trade and avoid unnecessary risks. Let's break down this example and see why it's a strong buy signal. The MACD blue line crosses above the signal line orange, indicating bullish momentum. The histogram turns green and moves above zero, confirming increasing buying pressure. A green candlestick crosses and closes above the 20 EMA, blue line, showing buyers are in control. When these conditions align, MACD crossover, green histogram, and price breaking above the 20 EMA, it signals a high probability buy trade. Now, let's take a closer look at this example where we encounter a false signal. At first glance, everything seems to indicate a potential buy trade. The MACD blue line crosses above the signal line orange, which is usually a bullish signal. The histogram turns green and moves above the zero level, suggesting increasing buying pressure. However, here's where things go wrong. The price action does not confirm the trade. When we look at the price movement, we notice that the green candlestick fails to cross and close above the 20 EMA blue line. This is a crucial confirmation step that is missing. Without this, the breakout lacks strength and the bullish momentum may not be strong enough to continue. This is why it's essential not to rely solely on the MACD crossover, but to always wait for price action confirmation. Now, let's shift our focus to the current trade setup and break it down step by step. According to our strategy, I should have entered a buy position here. However, I missed the trade at that moment, so the next logical question is, where is the next best entry point? Instead of chasing the trade, I patiently waited for a price retest. Here's what I was looking for. Both the MACD blue line and the signal line orange remained above the zero level, confirming that bullish momentum was still strong. The price pulled back to the 20 EMA blue line, which acts as a dynamic support level in an uptrend. Now, instead of entering too early, I waited for a clear bounce off the 20 EMA. The moment I saw the price reacting positively and moving back up from the EMA, I took my buy position. Now let's see how this position plays out. All right, I've decided to close the trade here and lock in my profit of $4,500. Let me walk you through the reasoning behind this decision so you can understand why I'm exiting at this point. First, let's look at the price action. I connected the first and second highs of the price from left to right. What do we see? The second high is higher than the first one, indicating an uptrend in price. Now let's shift our focus to the MACD histogram. Here, I did the same thing. I connected the first and second maximums of the histogram. But this time, the second maximum is actually lower than the first one, forming a downtrend in the histogram. When price is making higher highs, but the histogram is making lower highs, this situation is called bearish divergence. Divergence is a powerful signal that warns us of a possible trend reversal. In this case, the bearish divergence suggests that even though price is going higher, the underlying momentum is actually weakening. This often leads to a downward reversal. Since the signs of reversal are strong, I'm not going to risk giving back my profits. That's why I'm closing the trade now and locking in a solid $4,500 profit. This is a great example of why we don't just rely on one indicator, we combine multiple confirmations to make smart trading decisions. All right, that wraps up this strategy. I hope you found this video helpful and that it gives you more confidence in your trading journey. If you enjoyed this breakdown and want to see more, let me know in the comments. Whether it's a specific strategy, indicator, or trading concept you'd like me to cover, I'm always open to your suggestions. Your feedback helps me create content that truly benefits you. Also, don't forget to hit that subscribe button and turn on the notification bell so you never miss an update. And if you found value in this video, drop a like and share it with fellow traders. Let's grow together as a community. Wishing you all profitable trades and a successful journey ahead. Happy trading.